Welcome to this personal tax roundup for this month. My name is Dean Wootton. Today we're going to look at a IR35 case concerning Alan Parry. Now, Alan Parry is a Sky Sports football commentator. He trades through Alan Parry Productions Limited. Each of his 4 contracts that are under consideration were for a fixed period, fixed fees, and for a fixed number of matches. Now, Sky determined whether he worked at the football ground or in the studio. It was up to Sky. And with Sky's approval, he could provide a substitute, but he never did. There was one occasion when he couldn't fulfil a match for whatever reason, and Sky, they got somebody else to replace him. He didn't get somebody else to replace him, Sky did. Sky controlled the programming and its timing. The question was whether the payments under these contracts were caught by IR35. So up to the first tier they went. Now, the first tier said the mutuality of obligation existed. Alan Parry was obliged to provide a service to Sky, and Sky were obliged to pay him fixed amounts for those specified services. The substitution clause was of little relevance, and it normally is that way when there's high-profile individuals like Mr. Parry. Now, Sky clearly wanted him, wanted his personal services, so yeah, there may well have been a substitution clause in the contract, but it wasn't really valid. Sky's level of control demonstrated an employer-employee relationship. Sky controlled when, where, what, how Mr. Parry worked. So in the first tier's eyes, the relationship between Sky and Alan Parry was one of employment. He wasn't carrying on a business in his own account. He was caught, or his company was caught, by the IR35 legislation. And this is quite typical of those high-profile cases where the individuals are what they want. You know, they want Mr. Parry to commentate on the events. When we go away from this, our normal clients are not maybe as controlled as, say, the likes of Mr. Parry. So, yes, it's a win for HMRC, but I still think it's restricted in importance to these really high-profile cases, the Sky contracts, the BBC contracts. Yeah, when we have just normal commercial contracts, where we do have valid substitution clauses, where we do have other work, etc., we do have control over when, how, what, etc., then we should still be able to have a confidence that IR35 is not in point for a normal client that we would see. Well, the next case we're going to look at is to do with umbrella companies. Lots of these are around in various different industries. Now, within the construction industry, for example, contractors frequently find workers through agencies. And the agencies may choose to use an umbrella company. And this umbrella company employs the construction workers. Now, Exchequer Solutions Limited was an umbrella company. And they employed workers under an overarching contract of employment. And they provided these workers to agencies, and the agencies then supplied those workers onto construction contractors. Now, the question for this particular case was whether the company employed the workers under an overarching contract of employment, and as such, each workplace would have then been a temporary workplace for travel and subsistence costs. Because when you're travelling to and fro a temporary workplace, then the travel costs, etc., are effectively deductible. Or if you were paid them, they are tax-free. Now, HMRC argued that each assignment was covered by a separate contract for each job. Therefore, each workplace where the worker went to was a permanent workplace. So therefore, PAYE national insurance should have been payable on the reimbursed travel. The first tier said the company is under no obligation to provide work or pay individuals when not working. The workers are under no obligation to carry out work through the company. So there was a contract of sorts, but it wasn't like a permanent contract where you do get that, yes, we're based here, and when we do go away to work under this one contract, we get those tax-free travel rules. So with no ongoing contract employment, then a separate contract was effectively created for each individual assignment, and therefore each workplace for each assignment became a permanent workplace, and therefore travel and subsistence expenses, when reimbursed, were taxable. If they weren't reimbursed, they wouldn't be deductible. So important case really, because there's loads of umbrella organisations out, not just in the construction industry, and there's loads of them. And it's whether the worker under that umbrella contract has a one contract of employment with that umbrella company. In this particular one, it was held they didn't. I think there's lots of reasons why, but the fact is, they weren't paid when they didn't work. So it's almost like a facility, really. They're not paid regardless of whether they work or not. So effectively what you have is lots of multiple engagements, lots of permanent workplaces. Now, this case is quite an odd case in many ways, and it's worth looking at, though, and it concerns Nigel Victor Gradage. Now, Mr. Gradage used Think Accountancy Limited to set up a personal service company, and he claimed that he received nothing about becoming a director. Now, he was paid a combination of low salary, high dividends, as is the norm. He was a little bit concerned about that, so he contacted HMRC, and HMRC said no, it's quite common to be paid low salary, high dividend in these situations. Now, he did become aware of press reports concerning Think Accountancy Limited, so he changed advisors. Now, subsequently, he applied to have his personal service company struck off. Now, the issue here was that HMRC found that Think Accountancy Limited was a managed service company provider, and Nigel Gradage's company was a managed service company. As such, HMRC issued POA national insurance determinations of around £31,000. Now, because this company was struck off, HMRC issued debt transfer notices to transfer the liability to him personally. Now, Mr. Gradage accepted that the managed service company rules applied, but he disputed that debt could be transferred to him because he was not a director. Now, even though he was formally appointed at Companies House, he tried to argue that he was simply a worker, not a real director. The director role, he was trying to argue, was performed by Think Accountancy Limited, so no debt should transfer to him personally. Now, the first tier found that Mr. Gradage was legally a director of his personal service company. He knew that he was operating through a corporate. He checked with HMRC that it was acceptable to operate that way. Now, to transfer the debt, he must have been the director at the time the debt accrued, which he was, so therefore the appeal was dismissed. So quite an odd case in many regards, because many of us wouldn't even think to look at it like that. But this chap tried to take issue with it. He said, no, I didn't realise I was a director. I was just advised. I was carry on as normal. So these types of arguments, I mean, if you set up a company and you're appointed a director, you do it all for your clients, they are fully aware what's going on. They are fully aware they're a director, shareholder, etc. To try arguments like this to say, well, I didn't know, isn't going to go very far. We now look at an interesting case concerning pensions and unauthorised payments from pensions. Now, Elaine Curtis was in financial difficulty. She was having payday loans and lots of other bits and pieces. So she wasn't in a good financial place. Now, a recommended financial advisor arranged a loan for her of £20,000 with Blue funding. He also recommended she transfer her occupational pension fund to a new private pension fund with fast pensions. Now, Mrs. Curtis is not aware that the loan and pension transfer were connected, and as such represented an unauthorised member payment. Now, following a nudge letter from HMRC, she submitted a tax return, but she failed to record the unauthorised member payment tax charge. As far as she was aware, she had no idea that there was one around. Now, HMRC, they were in time to open an inquiry into the return, but bizarrely, they chose to raise a discovery assessment. Now, the case went to the First Tier Tribunal, and the First Tier Tribunal concluded that the loan was an unauthorised member payment. Monies were paid from fast pension to Blue funding, and they did seem to be conditional, i.e. getting the loan was conditional on fast pension paying Blue funding some money. It didn't matter that Mrs. Curtis was unaware of that connection. They went on to say that HMRC, however, were not permitted to raise the discovery assessment as Mrs. Curtis had not acted carelessly. She'd sought the advice of an independent financial advisor, and there was no reason to suspect the loan and the pension transfer were connected. Furthermore, discovery assessments cannot be issued before the inquiry window closes. So actually, whether she was careless or not didn't matter, because they'd raised the wrong assessment, effectively. They shouldn't have raised the discovery assessment, they should have done a full-blown inquiry and gone about it that way. Had they gone for a full-blown inquiry, then the result, I think, would have been very different. But they didn't. They went for discovery, and the discovery assessments got it careless, etc., which that wasn't the case. And also, it was issued before time. So the appeal was allowed. I think in different cases, I think this could so easily have gone the other way. Had HMRC opened the inquiry and then pursued that route, because it is an unauthorised member payment. And I think I guess in most people, if you see an independent financial advisor and they say, look, I can arrange a loan, oh, and by the way, you're going to have to transfer your pension pot, then you kind of start to think, actually, are they connected? But in this particular case, I think because of Mrs. Curtis, who was maybe not as well versed in these matters as others, she just didn't question it. And she said, yeah, I'll have the money and here's my pension transfer. And it didn't, in her mind, occur. But I think in a lot of our informed clients, they would be a little suspicious of that. And also, hopefully, they would talk to us as accountants and we would say, hang on a minute, we've got to be careful here because what they're suggesting could easily be regarded as an unauthorised payment. And that could be a tax charge, etc. Well, let's now look at a really odd case, this one, because when you look at cases, sometimes you think, well, surely they would have done it differently and they would have got the result they wanted. But for whatever reason, things are not always structured as you think they should be. Now, in this particular case, Everscott Limited had borrowed an unknown amount from the Royal Bank of Scotland. Now, Ignatius Tedesco sold the shares in the company for 1.5 million. But under the share sale agreement, the shares would be sold free of that debt. So therefore, Ignatius Tedesco used the share proceeds to clear the debt. And the debt was nearly 700,000 at that point. And in 1617, the return showed the loan repayment as a deduction from his share proceeds to arrive at the gain. Now, HMRC accepted the gain was eligible for entrepreneurs relief. There's no problem there. But they said you can't deduct the loan repayment. Now, he thought he could, so therefore he appealed to the First Tier Tribunal. Now, the First Tier Tribunal, they'll just look at the law. And the laws for deductions from proceeds, you've got to hit Section 38(1)(b). The discharge of Everscott's borrowing was not expenditure on the shares, and it was not expenditure that was reflected in the state or nature of the shares. And as such, the debt repayment was not an allowable cost, and the appeal was dismissed. Now, when you look at this, so why didn't they just pay him less? Pay him less, and then pay off the debt. And then he would have had his share proceeds, entrepreneurs relief, on the net amount, effectively. But for whatever reason, it wasn't structured like that. They didn't go into the reasons why it wasn't structured like that. But when we're dealing with businesses, selling, etc., just be very careful to look at the tax implications of what the seller and the buyer are trying to agree. And I think when we're looking at that, we would have said, well, actually, you're not necessarily going to get that as a deduction against your proceeds. So could it not be restructured in a different way? Well, next up, we'll look at Seamus and Kavanagh. And this was, it almost looked like a case where they breached the conditions for entrepreneurs relief, or what is now business disposal relief, but they tried to argue otherwise, using arguments which were a little bit, I wouldn't say suspect, but they're not reflective of what the reality is. Now, in this particular case, Badger Group Holdings Limited was the holding company for an estate agency group, and Mr. Kavanagh was both director and shareholder of this company. Now, following share-for-share exchange, he acquired 1842, so 1,842 shares in the company. Now, unfortunately, that was literally just under 5%. Now, you need 5% for business asset disposal relief or entrepreneurs relief. The three other shareholders held the remaining shares. Now, in 1617, the company was sold to a third party, and Mr. Kavanagh received exactly 5% of the total proceeds. Now, you're kind of looking at this and thinking, well, maybe at that point they realised that actually he needs 5% for entrepreneurs. Now, he reported his gain in 1617 and claimed entrepreneurs' relief. HMRC said no. Now, did he hold shares in his personal company? Now, to do that, for the 12 months up to disposal, he must have held at least 5% of the ordinary shares' voting rights. HMRC argued that he held 4.997% of Badger's ordinary shares, i.e. less than 5%. You don't round up, so therefore he owned less than 5%. Now, he then tried to argue that other shareholders held 0.003% of the shares on trust for him, which was kind of reflected in the fact that on sale he got 5% of the proceeds. Now, the first tier found no evidence that any shares not resting in his name were held by the other shareholders on his behalf. The shareholders' agreement stated that each of the registered owners was the beneficial owner of their shares, so no evidence to support the beneficial point. At no point had Mr. Kavanagh questioned receiving dividends based on 1,842 shares rather than on a 5% holding that he claimed to have had. The appeal was therefore dismissed. So, again, it's one of those situations where at some point they must have realised, hang on a minute, you don't own enough shares. And at that point, they're trying to correct it. But it's too late, because he hasn't held 5% of the shares. He didn't have 5% of the dividends. He had 4.997%, whatever it was, of the dividends. So it's one of those situations where an oversight has been made, or maybe someone's not realised the impact of Mr. Kavanagh. Maybe he wasn't the person they were advising, the advisors. And it's only subsequently, when the business was sold, that actually he starts kicking off because he hasn't got the required 5%. Last up, we're going to look at an interesting case concerning principal private residence relief. Now, this was Gerald Lee and Sarah Lee. Now, in October 2010, Gerald and Sarah Lee jointly purchased land for $1.679 million. Now, the original house on the land was demolished and a new house was built. Now, 4 days after completion, on the 19th of March 13, the couple moved in. They lived there for just over a year. And then in May 14, the couple sold the property for the best part of $6 million. And they claimed PPR relief on the whole gain, because in their mind, the gain was on the property and they've lived in the property since completion. So full-blown PPR. Now, following an inquiry, HMRC raised assessments of £541,000 on each appellant, Mr. and Mrs. Lee, as they'd not lived in the house for the first 43 months of ownership of the land. So therefore, full-blown PPR not available. So let's look at the arguments. Well, HMRC argue the period of ownership in the legislation clearly refers to land. Now, the couple acquired, owned, disposed of a single asset, being an interest in the land. They made change to that asset, demolishing, building. PPR relief, in their mind, was therefore 18 over 43 of the gain, 18 being the last 18 months of ownership, as it was back then. Now, the couple stated the legislation was clear that the period of ownership related to the dwelling house. And under Section 2231 of TCGA 1992, no part of a gain shall be chargeable gain if the dwelling house or part of the dwelling house has been the individual's only main resident throughout the period of ownership. And they said, well, we moved in. Virtually straight as soon as it was built, we moved in. So therefore, full-blown PPR. The tribunal looked at this and they said, well, legislation can contain no clear definition of the period of ownership. On a natural reading, period of ownership meant the period of ownership of the dwelling house that is being sold, because at the end of the day, that is what you're selling. The tribunal commented that no mention is made of land in reference to period of ownership in the legislation. As a result, the couple's appeal was allowed. So full-blown PPR on the sale of that property. Now, this obviously has lots of planning implications, but you've got to remember this is just first tier. It's not necessarily going to be a binding decision, not like an upper tribunal decision of said this, upper tribunal said this. So we have got to look at it and treat it not with a pinch of salt, because it is a decision which we recognise. But when we say to clients, look, let's go for full-blown PPI, in similar situations, there is a case which supports your situation. Let's disclose the fact that that's what we've done. But HMRC may question it and take it from there. At least we've identified that there is a difference of opinion from HMRC as to when the gain should run from and to. But they've lost a case on that in the first tier. Maybe HMRC will appeal this, maybe they won't. But do be careful with this case if you're using it for planning purposes. I definitely would disclose in the white space. I'm basically relying on my interpretation of the law and this case to claim full-blown PPR in similar circumstances. Well, that concludes the personal tax roundup for this month. My name's Dean Wootton. Thank you for listening.